Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Kaufman, Global Head of ETFs at Calamos Investments. And we are talking about autocallable ETFs today. These are new and really interesting products, and they offer very juicy income. So that's why they have become very popular with investors. At the same time, they are not simple. These are complex products, and that is why it is really important for us to understand how they actually work. So that's why I'm really looking forward to this conversation with Matt. Matt, welcome back. Thanks for joining us today.
Yeah, great to be here. Thanks for having me back. Always a pleasure.
So investors searching for income have been flocking to ETFs that use derivatives to generate these eye-popping yields. And autocallables are the latest evolution in this derivative-based income space. And our friend at Bloomberg, Eric Balchunas, he has called these products Yield 3.0. And in fact, he named your CAIE ETF as one of the most interesting ETFs of 2025 when he joined us on the show a few weeks back. So these ETFs are new, as I mentioned, but autocallables are not new. They have been popular with high net worth investors because of their juicy coupons, but they were not available to retail investors earlier in a low-cost, transparent ETF wrapper. Let's start with some basic questions. What are autocallables? How long they have been around, and how big is the market?
Yeah, thanks for that intro. And if Eric's listening, appreciate that nod there to the ETF. It has been a remarkable growth story. We launched CAIE in June, the first autocallable ETF in the market. We were approaching 600 million across the suite. We've got CAIQ as well that we launched, the Qs version, in November. So we are getting significant inflows on a weekly basis. I don't think we've had a week of outflow yet. So knock on wood that continues here. So the market is adopting this type of derivative income strategy. So maybe we'll start there and frame that derivative income landscape up, because it gives us a good framework for then understanding the autocallable income space. So over the last decade or so, we have seen this tremendous growth in derivative income strategies. Most people are probably familiar with covered calls, where you sell off your upside, you collect an income payment or a premium income, as a lot of those popular ETFs are named. You collect that premium income, and then that income level is tied to a reference index, maybe the S&P 500 or some other equity market. And the income that you generate will largely change with interest rates, with volatility. If vol is low, your coupon is low. If vol is high, when you strike that option, you can collect a little bit higher of a premium. Well, that space is now over 150 billion in assets in the ETF market. You can name your favorite covered call or equity premium income ETF. If you go over to the structured note side of the house, where you're not working with listed options, but you're building more customized options, that is where derivative income still dominates there as well, but it's largely done so through what's known as an autocallable yield note. And so to give you a frame of mind, that's a lot like a long-dated put writing strategy with a few bells and whistles on it. So you can't go out to the regular listed options markets and create an autocallable option. You've got to work with the bank in order to do that. But as the name implies, an autocallable option means that option can get called away if certain parameters are met. So if we just want to define an autocallable income note or autocallable put option, it's essentially a market-linked instrument, just like any other option, but this pays regular coupons and then will return your principal at maturity, or if called early, as the name implies, as long as a reference index like the S&P 500 does not fall below a specific threshold. So you can think of it a lot like a bond whose income and principal is tied to the equity markets, and it just depends on the equity market not falling too far. So that's largely how an auto-callable works. There's different terms that you would want to be familiar with, just like any other options-based product. So we can cover those briefly, but each one has a lifespan, usually 3 to 5 years, a coupon barrier. So, you might be familiar with a buffer that protects your money down to a certain level. Well, a barrier will protect your coupon down to a certain level. So let's say a minus 40% barrier means if the reference index is not down by 40%, you're going to get paid. And then if that reference index is down by 40%, since inception, maybe a monthly look, then that coupon will turn off and it'll turn back on again once the market recovers. And then the same is true for a maturity barrier, where the market has to be down by 40% at the end of the life of the option, at the end of 5 years, for you to have principal at risk. So as you can see, there's a high degree of protection. Mark to market, you'll move around like the equity markets, but you can know that you're getting a high stable coupon with principal return to you at maturity, as long as that index is not down too far. So it's a simple trade-off. It's really powerful. Bond-like income that's generally a lot higher than traditional fixed income. For our ETF, it's about 11% over the risk-free rate, in exchange for the risk that a severe market downturn could interrupt those payments. So I've talked a lot. I'll pass it back to you.
So let's talk a little bit about the ETFs. So if I'm an investor, can I just go to the bank, say JP Morgan, because I understand you work with JP Morgan. Can I go to JP Morgan directly and buy those auto-callable notes? Or that's not really an option for most retail investors? So in that context, we will talk a little bit more. When does an auto-callable ETF like yours make more sense?
Yeah, you can buy an auto-callable yield note from JP Morgan. In fact, they've sold about $4 billion or so worth of yield notes on the Mercube Vol Advantage Index, which is what we are tied to. You need investment minimums, typically $250,000. Sometimes there's lockup periods with that. You have to buy in at the beginning of the note. You get a note which gives you a termed performance, and then you own one of them. So a lot of financial advisors will try to ladder portfolios of these together. What we have done with CAIE is we worked with JP Morgan and with Mercube, and we built a laddered portfolio, a weekly laddered portfolio of auto-callable yield notes that are issued every week, and they all have standardized parameters. Each one has a 5-year life, a 1-year non-call period, so you cannot get called away for 1 year. It has 40% coupon barriers, and each one has a 40% principal maturity barrier. So you ladder all of these together, and you end up with this highly diversified experience all in a single ticker. And because we put it in the ETF wrapper, you introduce a whole host of efficiencies. You have liquidity. You can get in and out anytime the market's open. There's transparency into the underlying holdings. We've largely eliminated credit risk as well. We are not going out and buying notes from JP Morgan, which is unsubordinated debt. We do not have to do it that way. So all of this is synthetically done inside of a single index that we then trade on swap with JP Morgan. So our holdings are mostly collateral, mostly treasuries and other risk-free assets that sit at the custodian at State Street. And then JP Morgan has to pay variation margin for the swap as well. So worst case scenario, JP Morgan, the largest bank in the world, goes under. This looks a lot like a treasury portfolio in that instance. There's no debt structure to recover the money. It's sitting in collateral at the custodian. That is your money. And then the other piece, which we didn't talk about yet, is taxes. So we are able to generate really tax efficient income here. So about 90 to 95% of the income generated by CAIE and CAIQ is treated as return of capital. It's not actually returning your principal to you, but it's treated that way. And so that just means that your cost basis will be reduced over time. That will show up on line 3 of your 1099. And then if you hold until your cost basis is exhausted, let's say 6 or 7 years, you take 14%, eventually that will equal 100. And then you'll pay long-term gains on every income after that. Some people are, not needing all 14%. They might reinvest, let's say 7 to 10% of that. They'll create a really long cost basis for themselves, and with the goal of bequesting those shares to their heirs, who will then get a step up in basis. So that person or maybe retiree would largely generate tax-free income as long as they're willing to hold it until they bequest those shares. So there's really interesting and really opportunistic ways to use these two ETFs to generate a high, stable, and tax-efficient income.
So these are, again, complex products, and you explained how they work, and you also explained some of the terms like coupon barrier and maturity barrier, reference index, etc. Could you also explain how these are expected to behave in different kind of market environments, when the market is up or the market is down? What kind of outcome investors can expect?
Sure. One way to start simply, and one thing that we do as we train folks here as well, is we use monopoly money. So we'll use a $100 bill. And so, if I pretend like you give me that $100 bill, then it will be tied to a reference index, like let's say the S&P 500 for ease of use here. So if we move a long time, 1 month later, if the S&P is positive, then you will get $1. Let's just presume like there's 12% in annualized income, so $1 a month. So if the market's positive, you get $1. If the market is negative since inception, the next month maybe down 10, you still get $1. The next month, if it's down 30, you still get your $1. Next month, if it's down 40%, then you lose that $1 for that month. And then if the next month the market recovers, you start to get your $1 again. And then if you've held for a year, that note is live for 1 year. After the year, if the market is positive, you get your final $1. The principal gets returned to you. You get your $100 back. So then, where is the risk there? The risk is a severe sustained decline below that barrier where your coupons turn off. And then if the market does not recover for the remaining period, the remaining 5 years, so it's a 5-year look, then at that ending point, you will have principal at risk. And so what we do is we'll tear that $1, in half and give that person half of their $1 back, monopoly money. We don't want to tear real money, but give them half of that back so you can understand what the risk is. It's a severe sustained market decline that fails to recover. If you look at the strategy that we are running for CAIE, the underlying laddered index, if you want that ticker symbol, I know there's a lot of financial professionals that listen to this. That's MQ AutoCL, so MQAUTOCL. You can look at that performance on Bloomberg. You can go to Mercube's website. But if you look historically back to 2005, that's as far back as our vol surfaces will go, you would have received 96% of those coupons, 88% correlation to the S&P 500, about 18% volatility over the last 10 years, 12.6% annualized average income. And then you would have breached that principal barrier 2.8% of the time. So a handful of those autocallables matured below the barrier as a result of the global financial crisis. That was the only time, and it resulted in about a 17% loss of principal. So not 40%, you've got high degree of diversification. So I taught you how one autocallable note works. What we are doing now with JP Morgan and with Mercube is we are laddering together a portfolio of 52 or more of these. So 52 because 52 weeks in a year, and there's one issued every week. And then if the market's not positive after that 1 year, the note will just stay in the portfolio, continue to pay a coupon as long as it's above that barrier. So right now there's about 61 autocallables in the portfolio. You can see that live on a dashboard that we've built on our website. It will show you everything that you want to know and probably more about all of the underlying autocallables. What's the coupon for each one? Where are they trading relative to the reference index? Where is your coupon barrier at? Where is your maturity barrier? So it's all there for you to see. I would encourage people to look at that. But then to directly answer your question, in those up markets or flat market environments, we would expect full coupon and full return of principal over time. Again, the NAV will move a lot like the S&P 500 over time as mark-to-market performance. And then in that down market, let's say a sideways or down market, you will still likely get all of your coupon, but those auto-callables will likely be trading at a discount to par. From our perspective, that's an opportunity that you might want to take advantage of to buy in, because you'll be able to get all of that coupon and buy all of those notes at a discount to par. And so that creates capital appreciation potential plus that coupon amount. And then the severe sustained decline that fails to recover over a 5-year period would be the time where you might have some short-term coupon loss followed by a long-term risk of principal loss. And again, the only time we've seen that is in the S&P 500 as a result of the financial crisis. On the Q's version, CAIQ, that has had zero principal loss going back to 2005. I bet you would have had that during the tech bubble. Our vol surface doesn't go back that far, but I know someone out there is thinking of it, so I'm bringing it up now.
That's a pretty impressive performance. So, investors should understand that these ETFs have been around; they are fairly new, but indexes have that historical data which you mentioned, and they can check out the historical data. And one of these strategies has breached the principal barrier only 2.8% of the times, and consistent income of about 13%, right? And for the other strategy, the one tracking the NASDAQ 100, there was no loss of principal. And how much is the historical yield on that product?
Yes, the Q's version is 16% historical average annual income. It's a little bit higher because the barriers are set at -30 instead of -40. So the reason that we set them there is that the strategy has allowed for it. The NASDAQ 100 has historically appreciated faster and rebounded faster than the S&P 500. And so that's why you have that 30% barrier. It allows for a higher coupon, and it actually has had zero principal breaches going back to 2005.
Wow. So could you quickly walk through the two ETFs and the main differences between them? Because you mentioned that one has 40% coupon barrier and the other one has 30%, correct?
Yes, they are all built on the same framework. So we are laddering together 52 or more synthetic auto-callables. Again, you can think of them like 52 or more bonds that are tied to the equity markets. And they will pay that coupon. They will return principal as long as the underlying reference index, which is the Mercube U.S. Large Cap Vol Advantage Index. We should dive into that. And then the other one is the NASDAQ version, does not fall below the barrier. So for the S&P version, for CAIE, that's -40%. And for the NASDAQ version, CAIQ, that's -30%. So that's the only difference, is the underlying framework is S&P versus NASDAQ, and then 40 barrier versus 30 barrier.
Okay. And could you talk a little bit about the income advantage? What kind of advantages auto-callable income ETFs have over other income alternatives like other derivative-based income products or fixed income products?
So again, going back to the covered call space, when you generate income from covered calls, that income level varies because of market volatility, interest rates, other types of factors that influence the options pricing model. Dividends is part of that. We have stabilized a lot of those factors. So every week when we are writing that long dated put option, we no longer have to worry about dividend risk. We no longer have to worry about volatility risk. And so that is what we built into the index that Mercube has, that Vol Advantage Index. So there's essentially three reasons that we're able to deliver that high coupon. A lot of folks will say, how do you get to 14%? How do you get to 17 or 18 for CAIQ? It sounds too good to be true. What's the underlying driving that? So step one, you go out longer on the curve. You go out to 5 years. You write a 5-year option instead of 1 year, and you can pick up a little more income. And then the other more important factors here is we have an S&P 500 or a NASDAQ 100 futures base to the index. So this is the reference index that we're tied to. This helps eliminate dividend uncertainty. And so when you think about an auto-callable, banks are long dividend risk. They have to anticipate the dividends they're going to receive over the next, let's say, 5 years, if it's a 5-year note. So if you use a futures reference point, it eliminates the dividend uncertainty. So that attributes to a higher coupon. And then more importantly, we have a volatility control mechanism. So rather than letting the market dictate what our income is, we have a weekly implied volatility target on the S&P or on the NASDAQ 100, and that is a 35% vol target. It's 35% so that when we sell that call or sell that put rather, we're able to generate a high premium, and that premium is going to be stable, and it's stable at about 10 to 11% over SOFR for CAIE, and it's about 13 to 14% over SOFR for CAIQ. So that's not the volatility of the ETF. I want to be clear. The vol of the ETF is around 18% over the last 10 years. So we've got this high vol target as the reference index. And then we also have what's known as an annual decrement. And that is a way to reduce performance of the reference index and apply it to the coupon. So think of it as a 1.5, 1.6 basis point reduction every day, every trading day, that just gets applied to the coupon rate. We're able to take S&P 500 performance and give it back to you as an income payment. So you wouldn't want to invest in this product from a growth perspective, an outright perspective, but when you're trying to design something for high stable income, then you want to build an index that has a high vol target that has historically not breached the barriers that you have chosen. And so that's what we put together here. It's a high vol target index and you put 40% barriers on it and ladder it out 52 or more times. And you are left with an experience that looks like the S&P 500 with an 18 vol that you can turn in for a high stable coupon. So you put all of that together. A lot of banks have their own vol targeted indexes. JP Morgan works with Mercube. So we have taken their version of this yield note strategy and delivered it in the ETF form. And from our perspective, it's been a phenomenal partnership. And I think this is the one to do first in the market. And we've got a pretty good market share right now relative to others. So people are choosing CAIE and CAIQ. And I think it's largely because of the high stable income. And then in addition, the tax efficiency that we're able to deliver.
Yeah, very interesting. So it appears that these products are best suited for investors who are not very bullish or bearish on the market, but also need a high level of consistent income. Is that correct?
If you're thinking of it from a growth perspective or relative to the S&P, if you think the S&P is going up by 14% or more and you're just wanting deferred growth and you're not going to take that as income, then that might be true. But what we are seeing is people are using this for income. They're using the equity sleeve to replace maybe the S&P 500, but turning it into a high stable income. Some folks are using it as a high yield bond replacement, liking it to the high yield bond defaults in 2008 versus some coupon misses during the financial crisis for the CAIE strategy. Others are using it as a tax efficient income solution. So some are holding munis as their core. They're swapping out a little bit of high yield muni exposure for this and getting a really high tax efficient income. So there's a lot of different reasons and ways to use this. For retirees looking for income, if you're comfortable with equity market like risk, which a lot of retirees, theoretically should be if they've got a long time horizon. You've got to be in the equity markets if you want to provide for yourself and outpace inflation over time. And so this gives you that high stable income. The coupon amount is just that. It is dollars based on a par value. It is not a distribution rate based off of NAV, where that might result in a significant drag over time. The goal here is to deliver the same dollars to you regardless of movement in NAV. And so that's a great retirement tool if you're comfortable with the NAV moving around a little bit. You can turn it in for a high, stable, tax-efficient coupon.
So you mentioned that some investors are using it in the equity sleeve and some in the fixed income sleeve. In your view, where do these fit in a portfolio, in a traditional, say, 60-40 portfolio? Should they be in the equity sleeve or in the bond sleeve?
That question is starting to morph, and I think the answer has been morphing over the last 10 years or longer. The zero rate environment post global financial crisis, I think, caused a lot of people to question the combined merits of fixed income, where you used to use those bonds for both ballast and for income. I think that's starting to be separated now, and people are looking for the equity markets either for risk management, and now in the premium income space, they're looking for income from the equity markets as well. And so I think that 60-40 model of stocks and bond mix is starting to, look a lot different, where we've got this growing alt sleeve. So for those with that alt sleeve, this could fit squarely into that. It's a derivative income category. Others are selling out of equities because of the volatility profile. And then others still might sell a little bit out of bonds and move into CAIE because of the income component. But you're not going to get a whole lot of ballast if you're from CAIE if you're subbing out a fixed income product that might not move around as much. So you just have to be aware of what you're getting in for. But I would say a lot of folks looking for income that are comfortable with the equity risk are moving squarely into the equity bucket and turning that into a high income stream.
Makes a lot of sense. We'll have to leave it there, Matt. But
Okay.
Thank you so much for joining us today and for sharing your insights. And congratulations on the success of these products.
Oh, appreciate it. Thanks for having me.
That was Matt Kaufman from Calamos. The two ETFs that we talked about today, the first ETF that they launch is the Calamos Autocallable Income ETF, ticker symbol CAIE. And the NASDAQ version, which made its debut a little later, is the Calamos NASDAQ Autocallable Income ETF. The ticker symbol is CAIQ, and this, of course, has a higher yield than CAIE. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.